Hello there. Welcome back to Business Enterprise Skills, Zimsec O level. Today, we want to look at a section of sources and finance. And we are going to start by trying to understand what does sources of finance mean. But basically, for sources of finance, we're just looking at the funding of a business organization, where the funding is coming from, the money that is going to be used by the business to finance its operations. We want to see where it's coming from. So that's what we call by sources of finance. So the definition that we have here in terms of sources of finance is reading: this is the provision of finance to a business to fulfill its operational requirements. So operational requirements basically explains the day-to-day operations of the business, how they are going to be funded. So where does the business get the money? Is now the question that is describing sources of finance. So in terms of sources of finance, we see that we have got two main types of sources of finance that are listed here. We've got internal sources of finance, and also we've got external sources of finance. So we want to go through the first part, that is internal sources of finance here. But internal sources of finance on its own defines that this is finance that is originating from within the organization, inside the organization. So we can go through the definition that we have here, saying these are funds that the business can generate on its own, that is inside the organization or the business. When we have finance being originated from inside the organization, that's what we call by internal source of finance. So if another explanation in terms of internal source of finance, that reads: the process of a firm using its profits or assets as source of capital to fund its operations. So this is what we have in terms of internal sources of finance. Then we can move on to examples now of internal sources of finance, which options do we have when a business wants to generate its finance from within or inside the organization or the business organization. We've got example that we have there. We've got retained profits, and this is the first example that we have of internal source of finance. So on retained profits, what we are saying is these are the profits that are being made by the business after deducting mainly tax and dividends. After we've deducted income tax and dividends, but the profit that remains can be reinvested in the operations of the business. So this is explanation in terms of retained profits. Then our sale of assets, remember, assets, they are general resources of a business. So when these assets are being sold, this can be also a source of finance. Then a sale of stock, we know that on a trading business, which engages in buying and selling of goods. When those goods are being sold, they represent stock. So when we sell those goods, we are also generating money and finance the operations of the business. So we know that stock generally is a current asset. We classify it as a current asset because we understand stock is going to stay in the business for a period of less than a year. So within the framework of that period that it stays, we classify it as a current asset. Then I also have sale of fixed assets. So on assets, you see that we have two classifications of assets, that is a current assets and non-current assets or fixed assets. So when we are selling fixed assets, example of fixed assets that we have with equipment, and building also can be fixed assets, property, etc. So when we are selling those fixed assets, we are also generating money to finance operations of the business. Then also we have got debt collection is the last example that we have in terms of internal sources of finance. Debt collection, we are saying when we are selling goods, when credit is a trading business, we call the people or businesses that we are selling to as our debtors. So when we are collecting the money that they are owing us, we are embarking on debt collection. So this is what we have in terms of internal sources of finance. Then we can move on to external sources of finance now. The explanation of external sources of finance means these are sources of funding that come from outside the business. And the second explanation is funds that are available to business organizations that are derived from outside from outside the boundaries of the organization itself. So whenever funding is being sourced from outside the business organization, we call it external sources of finance. So we also have some examples that we have in terms of external sources of finance. We are seeing that we have got trade deficit is our first example, and then we've got the bank overdraft is our second example of external sources of finance. Then we've got trade debt factoring, and then lastly we've got bank loan. So on trade deficit, generally what it means is we are buying goods on credit from our suppliers. It means we are owing them money. So when we delay payment of those goods that we are buying on credit from our suppliers, that is what we call trade deficit. So the period that we've delayed to pay, it means that money can use it alternatively for the funding of the operation of the business. So this is what we call by trade deficit. And the bank overdraft, you understand this is a current liability. We classify it within the context of preparation of financial statements, having the income statement in particular, and we classify it as a current liability. So what happens on bank overdraft is when a business withdraws money from its bank account that is more than what is in the business, it represents a bank overdraft. So we can have an example of a business having a balance of $100 in its account, and it goes on to withdraw an amount of something like 150. It means the difference that we have here, 150 minus 100 represents our $50. So this one becomes our bank overdraft. So this one becomes our bank overdraft. So this is what we have in terms of bank overdraft. This 50 is indicating that it's also coming in as a source of finance, as this can be used in the operations of the business. So we also have a debt factory. Debt factory generally, remember we are saying when selling goods to our customers on credit, they become our debtors. And when they take long to pay back our money, we can sell those amounts to a factoring firm at a discounted price so that they can be collected by that factoring company. So when we sell at a discount, it means that a company will collect the balance that is being owed by customers, and they get the difference. So basically, we are trying to retrieve our money so that we do not lose everything. Remember, these debtors can also become paid debts if we relax and leave them there. They might not pay back our money. So this is debt factoring. And then we've got the bank loan. Is the last one, bank loan. This is generally the accessing of funds from financial institutions. Remember, bank loans attract interests. That is, we borrow money from our financial institution, be it banks, etc. And then when we're paying back that money, obviously we're going to pay with an interest. So this is what we have in terms of our external sources of finance. So let's stay tuned for more videos that are going to come. Next videos, we are going to look at some of the examples that we have there of sources of finance, be it internal or external. Then we try to evaluate in terms of the viability of using those different sources of finance by looking at the advantages and disadvantages of those sources of finance. But as for this video, signing out, we'll meet again in the next video.